Investors Chronicle.
Hello and welcome to the Companies and Markets Show. It's Thursday, the 4th of July as we record. The day of the general election. By the time you hear this, the result will be known. Of course, we don't know the outcome ourselves, so while we can take a pretty good guess, we're going to keep our pontificating on that subject to a minimum. Instead, we'll start today looking across to the other side of Europe at listings platform Baltic Classifieds, which reported full-year figures on Wednesday. Jemma Slingo, our ideas editor and lover of unusual companies of this ilk, is here to provide her thoughts. Then we look at a microcap tech, or at least tech-adjacent business, ActiveOps, which also reported this week and has secured the backing of a variety of professional investors. Mark Robinson will look at the business and its prospects. Finally, we are going to examine a couple of outsourcers, Serco and Mitie, both of whom also updated the market recently. Jemma is on hand again to discuss the pair, as is Julian Hofmann, and we will dabble a little bit in politics at the end by considering what they might expect from a Labour government. As I say, though, we will remove ourselves from these shores to begin with. Baltic Classifieds, as the name suggests, it's a company focused on Lithuania, Latvia and Estonia, chiefly the first of those. Jemma, it's always struck me a little bit as a sort of a cross between Rightmove and Auto Trader, but can you tell us in a bit more detail what the business actually does to start with?
Yeah, I think a cross between Rightmove and Auto Trader is about right. So for a bit of context, it listed in London in 2021, but as you say, it's solely focused at the moment on the Baltics. And it basically owns a collection of websites where either individuals or companies can post adverts for things like cars, jobs, real estate, other miscellaneous items. And it's quite difficult from a UK perspective to know how popular these sites are because looking at the list, I wasn't familiar with any of them. But it seems that the traffic they get to these sites is enormous. So management said in the latest results they get about 56 million visits a month. And based on the population of the Baltics, that means basically every person there is visiting one page about 10 times a month. So it's clearly big in the region. And yeah, it had another great year of growth. So sales were up 19%. Operating profit was up by almost a third at 38.3 million euros. So it's on a pretty good streak at the moment.
These companies are, occasionally you get them in the UK, don't you? Companies which are very much focused elsewhere. And as you say, it can feel unusual to not have a sense of what these businesses are. But they do have, by all accounts, dominant market positions, certainly in the big areas of cars and real estate, which are the two biggest revenue drivers for the business. Can we look a little bit, though, at the way it's planning to expand now? Because the company, although it listed only a few years ago, it has been in place, as that dominant market share would suggest, for quite a long time in these markets. How is it planning to eke out more growth? What's it doing? What are the prospects, the attractive prospects for investors?
So last year, there were a variety of things that were driving growth. So they were saying that more customers were picking the premium listing packages, which obviously means they get more money for it. Products are taking a bit longer to sell, which means they get more sustained ad revenue from different customers. And there was also extremely strong growth in the number of consumers who were placing ads, and that seemed to be a big thing that management were focusing on. But I would say a particularly interesting thing about Baltics Classified is the fact it's still at quite an early stage of monetization compared to something like Rightmove. So it still has plenty of scope, according to analysts, to put through price hikes. And that's something they did do in the latest period, and that increased yields across all the business lines. And speaking to the analysts they all seem pretty confident that there's plenty of further distance to run in that regard. And there's also scope to add in ancillary services. So if you think about products being up for sale, you can then add sort of a delivery option, which would provide a little boost to the revenue. And it was interesting because one analyst I spoke to basically said the company doesn't have to be that innovative. You've got Rightmove, Auto Trader right there, which have already established the roadmaps that work. So they can basically follow that trajectory. And from a management perspective, there is a lot of overlap between those three groups. People have been sort of shuffling between them. So it seems like it's in an interesting position in its story at the moment.
Yeah, another string to its bow. It does have, even by the standards of these kind of businesses, it does seem to have very high margins, and there's some potential for those to increase as well via some of the initiatives you've been speaking about and cost efficiencies too. And I think they are quite I looked a bit at the analyst call and listened in, and they were saying, some people think our margins are because we don't invest in the business, but as you'd expect, they were very much insisting they do, and actually it's due to the efficiencies of the business model. There are a couple of external factors to watch for, though, that we should talk about. The first being the shareholder overhang, because Antler, which is owned by Apax, the private equity firm, did have at the start of this year, I think, about a 30% stake. It's sold that down quite considerably in recent months to about 11%, I think, last I saw. Clearly, that's caused some share price volatility as those stake sales have gone through. The good news, I suppose, is that now it's down to 11%. There's not much more of that can happen. So it could be a clearer path in that regard in future.
Yeah, you'd hope so. So this is the private equity firm that bought Baltic Classifieds back in 2019 and is now basically selling chunks of its stake. Management was saying in the earnings call that, it was positive that this had happened. The overhang had been reduced. And it's important to remember that at the same time, Baltic Classifieds is buying back its own stock, which is obviously helping to counter that process a little bit. And it is ratcheting up its dividends. So about 50 million euros of cash has been returned to shareholders since the IPO, which only seems to be travelling in one direction, it seems, because it is a very cash generative business. So I'd say sort of concerns about that and the share price volatility associated with Apax are definitely in the rearview mirror.
The other aspect are regulatory issues, and something which you might expect from a company with a fairly dominant position. Regulators have been taking an interest, notwithstanding the fact it still has room to grow, as we've been saying. This is mainly in Estonia, I think, but there was some positive news there as well.
It is. I mean, I can't say I am an expert on the Estonian Competition Authority, but I do know a lot more about it now. So in the latest set of results, they said this competition authority had ended an investigation into the group's real estate and auto platforms, basically concluding that the prices weren't too high and that it was all fine. So that seemed to be a weight off their mind. There's one remaining supervisory proceeding with that regulator, but as of, I think it was autumn 2022, there's been no updates. So it seems to be, I don't know if they've kicked it into the long grass or what, there haven't been any sort of major shocks recently. Management did say that that particular proceeding can't result in an immediate fine, but the company could face certain restrictions or potential misdemeanor proceedings as a result of it. But at the moment, it's all up in the air, I think.
It's interesting they haven't heard anything for coming on to 2 years now. You'd think they'd try and give them a nudge to at least say, can you tell us if this is closed? I mean, it seems like it might be closed, but they still include it in risk factors, so clearly it's something to keep an eye on. Estonia, I think, is about 28 to 30% of revenues overall. As I say, Lithuania is 30%, and Latvia a mere 2% currently, so it is skewed quite far towards the Lithuanian side of things, and there do seem to be some fundamental drivers there as well. The Lithuanian economy, with which I too am not particularly familiar, but it does seem to be on an uptrend at the moment. It seems that population growth is coming back after a lot of years where people were moving away. So those kind of fundamental drivers should help support them as well. The question we always end with good reason, is on valuation, which does look relatively rich by some metrics, but there's still potential there.
Yeah, it's quite steep. So it trades on a forward price to earnings ratio of about 27 as of this morning, whereas companies like Rightmove are on about 19 times, 20 times, and Auto Trader's a bit higher. So it is on a premium to its bigger peers. But then, as we've said, it's at a far earlier stage of its growth story with far longer to run, I suppose. So you could say that multiple looks more reasonable in that context. I was looking at a note from Investec, and they were arguing that the company could achieve earnings growth of 20% a year for many years to come because it has all these different profit levers. So there is this sense of optimism, I think, even though, as you say, it is quite richly valued. And it is in a part of the world which many UK investors will be less familiar with. So it's harder to assess some of those macro forces and I suppose the geopolitical risks as well.
Yeah, indeed. Something, given the spread of its business, the business lines at least, as we've discussed, automotive, there's some good potential there, real estate, the jobs market, the generalist segment, which includes all kinds of things, one imagines, that aren't included in those first three groups. You would think that, there are plenty of growth options to come. Let's turn now, though, to another company, another tech-ish company, albeit on a much smaller scale at the moment, and that's ActiveOps. Mark, you covered the results this week. Should we start by talking about, again, what the business actually does? Because it's one of these companies that has started using the word AI quite regularly. Perhaps, to be fair, they've been doing it for a while, because it does seem like the kind of business where AI could have some real applications quite quickly.
Yeah, it's very much of the zeitgeist. When I looked at it originally, they described their activities as surrounding decision intelligence, and I guess that it means that they use a combination of cloud-based AI capabilities and human, consultancy. I can't think of a better term for it than that. Uh, Basically, they target a fairly narrow band of sectors within the economy: healthcare and banking and insurance, and their technology is applied across there. And it basically means that people within the company, whether they be salespeople, upper management, can make sort of the best decisions because AI basically they collate large amounts of data from the data sets within organizations. And I'm not quite sure, I've never used the software myself, but presumably it gives you a range of options for the decision-making process. I guess it's analogous to an old-fashioned consultancy in that regard. They operate a software as a service model, which has some advantages too. So I guess it's very much of the age, and it's a marketplace that's obviously growing at the moment as well. So it was quite interesting. I never looked at the company prior to this as well, and there's a limited amount of research linked to it.
Yeah. I mean, the interesting aspects of the company and what it does for me is a lot of it is relating to the decision intelligence, as they call it, is relating to the workforce. It gives tools effectively boosting productivity. AI is always ostensibly doing that, but they're looking at how employees are performing and where they're putting their efforts and whether those efforts could be better redeployed elsewhere. There's employee monitoring services, which, having looked at some presentations, they're quite keen to insist are not about these kind of things you hear about where they're just making sure people are wiggling their mouse every 5 minutes. It's more about trying to work ethically, as they say, trying to find out, whether employees are overworked, they say in some cases, and whether they can therefore utilize other aspects of the business to help them out and things like that. So it's very much about, I think, if you're a manager, having this data set to see how your teams are performing. And one thing they've been trying to emphasize over the last few years, as you'd expect, is with teams now being more remote, these kind of services are much easier or much more valuable, as opposed to when everyone was in the office all the time and you could, to an extent, because there's still issues there, but to an extent you could always see and speak to people in person about what was going on at any given moment. Clearly that sounds like something which could be quite useful. You can now get 12 weeks of an Investor's Chronicle print and digital subscription for just £12. You'll get instant access to our website and our app, plus the magazine delivered to your door every week. Check the terms and conditions in the show notes for more information. What did you make of the results themselves, the full year figures for the last year that have just come out?
Well, they've got into, in terms of the reported figures, profitability and earnings were positive for the first time as well. The growth in revenues over the last 5 years have tended to be incremental, which is possibly at odds with the impression that people might gain of a company like that. They've got a decent cash buffer. A company like this, any software company really, they need to renew the product constantly, and so they give a fair proportion over to capex and product development, and yet the balance sheet's in pretty good trim. No dividends at this stage because they're in that development phase at the moment, and they're not going to start paying out until they've got a sort of a critical mass in terms of sales and renewals. The most impressive thing of the results themselves aren't necessarily so much the profit numbers, but the fact that revenues, for instance, they have a real high proportion of recurring revenues. This is one of the underlying benefits of a software as a service model. Those high retention rates, and they've got a number of advantages, and they also feed through into improved cross-selling opportunities to, as I say, the company's constantly updating the product. And that's that's a real plus. In terms of the valuation, I guess, is based on that as well. It's difficult because the company, it's got limited broker coverage at the moment, only a couple of brokers as far as I could see. The share price is a drift of the target range, but it's got a real tech rating too. And I spoke to Simon Thompson about this, and I think he was he found it pretty hard to justify the rating, which is about 50 times forward consensus earnings. It drops down to around about 40 once the net cash is taken into consideration. But it's pretty hard to justify that rating given the growth rates in the company at the moment. So I guess when you look at any software developer like this, there's always a blue sky element. And it underlines the fact when you're looking at this sector, and there must be so many speculative bets put in a company like this, because unless you really know the underlying product, you're a bit of a hostage to fortune really with this type of company. I mean, you would imagine as well that this is going to become an increasingly crowded field too. Not just because of tech, when people can see the applications, other companies are going to enter the fray. But it's still an interesting one. I mean, it's the market cap is 80 million at the moment. Interestingly as well, I looked at before we go down actually who owns it as well. It had a pretty narrow spread yesterday, and so I was thinking, oh well, that it must have a decent secondary market. But when I looked at the record over the last 3 years, the volumes have been fairly low, and you just tend to get erratic movements in the share price. I don't know whether that they've got a fairly high rate of institutional backing. I think you've looked into that, haven't you? So
yeah, they do have a decent amount. That liquidity issue is always nowadays there, isn't it? Certainly for sub 100 million companies, they do seem to have attracted a bit of attention. Did a separate feature this week on shares that are featured among the best performing UK smaller company fund managers, top 10 positions. ActiveOps wasn't right up there, but it was in a couple of the micro nano cap funds. Lion Trust, I think, took a position last year when ActiveOps turned profitable, I think at the half year stage. Marlborough for managers as well have got a position there, and you look at the shareholder register, the likes of Schroders are on there too. So there is some interest from the institutions there in the business. As you say, that valuation right now does look quite rich relative to the growth rates, but it seems to have some success. It mainly sells into, as you mentioned, financial services, into banks. Maybe some of these asset managers are more familiar with the software because it's used in their businesses. Who knows? I think it is mainly banks rather than fund managers, but they've had some successful wins. They're working with some of the leading companies there. We don't know, of course, how much they get from each business is the question really, and how many customers they actually have per.
And you'd imagine over time that those applications would potentially increase too. The insiders as well, I think they account for about a quarter of the shares, and we always like it when that's probably not unusual for a tech startup as well, but it's always better if there's the insiders have a bit of skin in the game as well. In many ways, you look at it and it's just the type of company that AIM is trying to attract. I mean, that's what the whole reason why that market was set up, because I mean, it's potentially risky, and it's not a risk-free investment, that's for sure, but it's that growth trade-off. The only point that I'd make on it is that you would hope to see an accelerated growth rate in terms of revenue and operating profits in the years ahead. But the research that I've seen so far, that there isn't much of an indication of that, unfortunately.
Yeah, I think it's ticking along, isn't it? But with the
Yeah.
current valuation, you might need a bit more. But it's certainly an interesting business, and as we say, a kind of company that you don't necessarily always get too many of in the UK. So they're clearly doing something right, and we'll keep an eye on them as the months and years go by. But we're gonna go up the cap scale to finish. As I said at the top, we are looking at the outsourcers now. Let's start with Serco. Jemma, I'll come to you again because they had a trading update out the other day. As things stand, looking pretty good, guidance raised and a general sense of positivity.
Yeah, it was good update. So they now think that adjusted operating profit, will be £10 million more than they'd previously thought at 270 million. And if they do achieve that, it'll be 9% higher than it was last year. So the general mood is good. Free cash flow is also expected to be a bit better than expected. And on the other flip side, adjusted net debt will be a bit lower. So in the world of outsourcing, everyone seems to be fairly cheerful at the moment, I'd say.
For now, indeed, at least. What about coming up in the second half? There is a big contract up for renewal. Obviously, this is always an issue with outsourcers. It's very hard to, impossible to tell ahead of time whether these contracts will be renewed. And there is one coming up that is a fair chunk. Yeah,
so it is a bit of an occupational hazard, really. But this was flagged by HSBC a couple of months ago. Basically, Serco's provided facility management services for immigration detention centres in Australia for years and years now, since 2009. And the contract is up for rebid and the decision's due later this year. And according to this analysis by HSBC, the contract currently represents about 5% of group revenue, and it's higher margin than a lot of the other work that Serco does. So there is a risk that if they lose it, the market will not react well. And some investors might remember when Wincanton, which is a delivery company that used to be listed in London, lost a UK government contract, and the shares absolutely spiralled after that. So there is this nasty sense with outsourcers that things could be going perfectly well, and suddenly you get a shock and shares suddenly dip. But on the whole, sort of across the group, trading seems to be going very well.
Mm-hmm. We'll come to Mitie in a moment and discuss some political aspects too, or maybe we'll do that now because, Julian, you've been waiting patiently on the sidelines. What are your thoughts on Serco at the moment, how it's looking?
Yeah, I mean, unfortunately, I can't hide how much I detest these companies. The problem with outsourcers, as Jemma just outlined there, is that they often sell themselves to investors on the basis that they generate stable revenues, and then actually the obverse is the case. So they tend to be very volatile in terms of the contracts they win, and the share price reaction as well is goes to extremes. So at the moment they're closing in on a 5-year high. But you can just predict that at some point there'll be some other scandal coming through, and the share price will crash. I mean, you just have to accept that that's the way of the world with outsourcers, really.
Someone else who doesn't particularly like Serco, or didn't, is currently, as we record, Shadow Chancellor Rachel Reeves, who in 2020 tweeted, "Sack Serco," and Labour do have an insourcing policy to come in for certain, I think it's more local government contracts than national at this stage. So clearly you would expect there to be some consciousness of that among investors. I think it's fair to say Reeves's opinion may have changed since then. Even in February on the last results call, Serco chief exec was saying they were encouraged by the consistency and constructiveness of dialogue with the Labour Party. I think they had a sponsorship deal at the party conference last year too, so they've clearly been trying to re-educate Rachel Reeves, shall we say. But it's clearly something to keep an eye on as well in the context of what we expect will be a new government and what we expect will be a slightly harder tone on the outsourcers. Jemma, why don't we finish by looking at Mitie, which maybe has, relatively speaking, better prospects at the moment within the context of the outsourcing sector?
Possibly. I mean, Mitie's been on a similar journey to Serco, I would say, in the sense that it had a terrible few years. Investors really fell out with it, and it seems to be in the process of rehabilitating itself. So it published its full-year results last month, and growth was good. So revenue was up 11%, and it's managing to widen its operating margin, albeit from a very low base in sort of line with other other peers. One thing that did strike me when I was looking at Mitie's results was their contract renewal rate. So that had fallen from 90% to 79% due to a couple of notable contract losses, is how it described it. And as Julian was saying, that renewal rate is absolutely crucial because it shows sort of how fierce the competition is in the sector and how well the companies are performing the work and how much their customers want to stick with them. So that's something to bear in mind, I would say. But I don't know, on the flip side to what Julian was saying, I'm willing to play devil's advocate a little bit, because from what I've been seeing, it does seem that these companies have turned a corner slightly from the disasters of the 2010s. So when you saw all these auditing scandals and companies getting embroiled in these terrible loss-making contracts, there does seem to be a recognition that they need to pay greater attention to the contracts they're entering and sort of the pricing pressures. So maybe there could be a bit more investor interest, but I mean, valuations are very unlikely to hit the historic highs that they once enjoyed.
Another thing maybe worth mentioning on the Mitie earnings call the other day, I think they were also asked, as you'd expect, about a change of government, and they said, well, actually, you might expect this too. They said, oh, well, we're not too worried about that, but also the insourcing in some ways is about making sure you're not just getting the cheapest possible contract. And they were saying, well, we've lost out before because we were offering, I think, the London living wage or something, and someone else undercut them. So in some ways they see that as a positive too. But clearly there's the potential for the mood music to change, I think it's fair to say, given prevailing attitudes about outsourcers, which in some cases, as we've discussed, are not entirely unjustified.
Well, I think Rachel Reeves as well, just to make this point, will have to make some determination in fairly short order, because the prison service is pretty much in crisis at the moment, and so they're going to have to make some alterations to the arrangements there. I think Serco still runs a handful of prisons in the country at the moment, so that will be interesting to see what her attitude is towards the company, assuming she's in power tomorrow.
Indeed. Well, it could well be all change on a number of fronts. There's certainly a long to-do list, but we will get to that in the weeks ahead as the plans make themselves known. But we have run out of time today, though, unfortunately. Thank you very much to Jemma, to you, Mark, to Julian, and to our producer, Maddie Apthorpe. We'll see you next time on another Companies and Markets show.